The ARK funds are on fire this year, easily the most popular stock funds with market-busting returns. The ARK Next Generation Internet, ticker ARKW, has surged 135% over the past year. The flagship ARK Innovation Fund, the ARKK ETF, has jumped 126%. Even lagging funds like the ARKQ and the ARKF have smashed the return on the broader market. But in this video, I'm going to show you a strategy to beat the ARK funds or any ETF you choose. I'll show you why this works and reveal that strategy. We're talking beating the ARK Invest funds today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, in more than a decade as an analyst and 20 years in the market, I have never seen an ETF as popular as the ARK Invest funds. These 5 actively managed funds target companies with disruptive innovations like robotics, fintech, and tech-enabled products or services that are changing the way the world works. The investment advisor was formed in 2014 by Cathie Wood after nearly 4 decades on Wall Street, most recently as the chief investment officer at AllianceBernstein. The ARK funds are well run and booming higher, and I love these funds. Everything except the price though. You see, because the ARK funds are actively managed funds, so the portfolio manager is tracking those stocks, buying and selling regularly to produce that market-beating return, these are going to be some of the most expensive funds in the market. For example, the SPDR S&P 500 ETF, that's ticker SPY, is a passively managed fund for all the stocks in the S&P 500 market index and charges investors a 0.1% management fee. Now, in a passively managed fund like this, all the manager has to do is just sit back and buy or sell the stocks when they're changed in the index, which really only happens infrequently. Actively managed funds, though, like the ARK ETFs, Cathie has a team of analysts poring over financial statements and cash flow models, looking for those innovative companies. To pay for this level of management, the fund charges 0.75% annually, more than 7 times that passive index fund. Now, a 0.75% fee doesn't seem like much, especially against a 100% plus return, but it does add up. With a single $100,000 investment over 20 years, you would be out almost $51,000 on the fund charging that expense fee of 0.75% versus the index fund and its 0.1% fee. And even that is over $8,000 more than a do-it-yourself strategy. $50,000. And what if you could get those same returns on amazing investments like the ARK funds, but get to keep all that money? That's what I want to show you in this video, how to replicate those returns on your own, keep the money, and reinvest it for an even bigger payday. I'll walk you through how this strategy works step by step, then use it on each of the 5 ARK Invest funds. And the beauty of this strategy is that it's going to work on any exchange-traded fund out there. If you want to beat the Invesco Solar ETF, ticker TAN, and it's 120% return this year, this strategy is going to work with that too. So I'm going to use the ARK Innovation Fund as an example first, show you exactly how this strategy works, then I'll reveal how to put this in action in each of the remaining 4 ARK funds. I'll then show you when to use this strategy and why some of you out there might just be better off investing in the funds themselves and paying that fee. So here we are on the ARK Invest website, and we see each of these funds listed on the right. We'll click over to the ARK Innovation ETF, that's ticker ARKK, and again, every ETF is going to have a page like this. You'll see a description and objective for the fund, and that's the theme or the index that it's trying to follow with these investments. In this case, the fund manager is investing in companies with a disruptive innovation in 4 fields: genomics, industrial, internet, and fintech. Now, you'll also see some details on the funds, like the number of holdings. This one just says between 35 to 55 stocks. And here we see the expense ratio, 0.75%. Now, a big misconception here that I wanted to clear up about these expense ratios. This fee isn't actually taken out of your account or your investments. Instead, the fee is just taken out of the fund assets regularly. For example, the ARKK has a $8.9 billion in assets. So with that 0.75% expense ratio, that means just under $67 million is taken out of those net assets over the year to pay for the management and other expenses. You never actually see this expense fee taken out of your investments, but the effect is going to be the same, lowering the fund value and your returns. You'll also find a lot of other information on this page, like returns for different time periods, but what we're interested in here is this top 10 holdings. Every fund is going to list out its stock holdings, every single one. You'll see the company name and the ticker symbol, as well as what percentage that stock makes up of the total fund holdings. For example, here in the ARK Innovation Fund, shares of Tesla make up just over 10% of the holdings. Invitae is around 8% and Square is 6% of the fund. Now that's just the top 10 though. Here you can click on to view all the holdings and you can see all 49 stocks held by the fund as of this reporting date. So do you start to see where we're going with this? The fund manager is telling you exactly what they're investing in and how important each stock is to those returns. You can invest in these same stocks, get the same returns, and not have to pay those fees. That's going to mean an extra 0.5% or more return to beat these funds. And why this strategy works so well with these smaller, actively managed funds is because they typically only hold a handful of stocks. In fact, you probably don't even need to invest in all of these stocks to replicate the returns on that ARKK fund here. Just the top 10 stocks make up 48% of the money invested, and if you just invested in the stocks with a 2% weight or larger, that's only 18 stocks to invest in and accounts for 2/3 of the fund. So here's the strategy in a nutshell. Go to the portfolio holdings page on any ETF and invest in the top 10 stocks held, or even down to the top 20 stocks. Now, how many of those stocks you buy is really up to you. Realistically though, if you're investing in even the top 50% of a fund, so in our ARKK example, those top 10 stocks that make up 48% of the holdings, you're going to pretty much copy those returns. Now, an important note here is that you have to buy these stocks in that same percentage as the fund. So on our ARK Innovation example, let's say we have $1,000 to invest to replicate this fund. We see that Tesla is 10.2% of the fund, so we would want to invest $102 in those shares of Tesla to get that same 10% weight. Now next here with Invitae, and it's 8.17%, we'd want to invest about $82 in that stock. Now this is where it's going to be helpful to invest on a platform like M1 Finance or something that lets you buy those fractional shares so you can invest exactly that amount in each stock. Now if you're only investing in those top 10 stocks, so if those percentages add up to about 48%, then you're really only investing $480 of that $1,000. And here, I think you can invest the rest in maybe a low-cost index fund that gives you that broad market exposure for that super low expense ratio. You're still going to mimic the returns on that fund almost exactly, because if you think about those remaining stocks that you didn't buy, for example, the 1.52% of the ARKK fund that's invested in Splunk, that's ticker SPLK, we see here that shares have done extraordinarily well, rising 74% over the past year. But the stock is such a small percentage of this fund, it only really contributes 1.1% to that overall return. And it is not that hard to track these funds. Most of these actively managed funds don't change that often, so you're probably fine just checking in on the holdings page maybe once every 3 months, every quarter, to see if it's changed any. In fact, ARK Invest actually allows you to sign up for trade notifications on the company's website, so that makes it even easier. So by just investing in maybe the top 10 or 20 stocks in the fund, you make your job a whole lot easier, get what's going to amount to nearly identical returns, all the while you're not paying that expense ratio because you're investing in these individual stocks yourself. Now that you have an idea on how this ETF beating strategy works, and go back and watch the strategy again if you need to, but now let's take a look at the other 4 ARK Invest funds to put this in action. The ARK Invest Autonomous Tech and Robotics ETF, ticker ARKQ, targets 5 themes: autonomous transportation, robotics and automation, 3D printing, energy storage, and space exploration. The fund holds between 30 and 50 stocks and charges that same 0.75% expense ratio. If we click over to the holdings, we see Tesla again at the top of the list with just over 10% of the fund. And just like that ARKK fund, the top 10 stocks account for 50% of the total holdings here. Now there are 2 really interesting points here looking at the stocks held in these funds. One is that you're going to see stocks held in multiple funds. In fact, there is a huge amount of overlap within these ARK Invest funds. Tesla is the top holding in 3 of the 5 funds. Our shares of Square, Roku, and LendingTree are also in 3 of these ETFs. So you don't even necessarily need those 50 stocks to replicate all 5 of these ARK fund ETFs. Something else you'll get just by exploring the pages for these funds, though, is an eye into the thinking and analysis by some of the world's best analysts. You get to see exactly which stocks they're buying, and a lot of times the website's going to have a blog or regular reports with commentary on what the manager is watching. This next one, the ARK Invest Next Generation Internet Fund, ticker ARKW, is one of my favorites because it's in what I think is going to be the biggest trends over the next few decades. The fund holds between 30 to 50 stocks in 6 themes: cloud computing and cybersecurity, e-commerce, big data and AI, mobile tech and IoT, social platforms, and blockchain. Now we'll scroll down to the holdings, and what shocker, Tesla tops the list here again. Now there are some others here on the list that I really like too though. Those of you in the nation will remember we recommended Pinterest last December, now up 176% since then. And I highlighted shares of Snap as the best investment in social back in September, up 75% just in the 4 weeks. This ARK Genomic Revolution ETF, ticker ARKG, is really interesting and a theme I don't think investors see as much as some of those internet high flyers. Again here, investing in 30 to 50 stocks in 6 themes. CRISPR, which is that gene editing technology, gene targeting therapeutics, bioinformatics, molecular diagnostics, stem cell, and agricultural biology. And there isn't nearly as much overlap here as we see in some of those other funds, though with the flagship ARKK fund, which also holds that Invitae and CRISPR therapeutics. Now nation, I won't say that any of the industries in these 5 funds are really easy to analyze, but this one strikes me as even more difficult because you really need that background in medical research and genetics just to understand these companies. Like, I can put together a pretty kick-ass analysis on Pinterest and Snap because social is a lot of what I do for my business. I know the business models here, but you asked me to explain how gene editing works with CRISPR and I might as well be a monkey with a violin. So if you're going to be investing in these types of intensely complicated industries or just ones outside of your experience, I really like this fund replicating strategy to piggyback on what those analysts are buying. This next fund, the ARK Fintech Innovation ETF, ticker ARKF, also invests across 6 themes: transaction innovations, blockchain, risk transformation, funding platforms, customer platforms, and new intermediaries. And we see a lot of familiar stocks here, not just the ones in those other ARK funds, but some popular stocks like Tencent, LendingTree, and Zillow. But now that you've sat through 10 minutes of how to use this strategy, now I'm going to piss on your parade with a few reasons you might just invest in those funds anyway. Because here you've really got to ask yourself, what type of investor are you and what your time is worth? Are you actively following your stocks, or are you just the type of investor that just wants to buy a fund and not look at it for years? Now, if you're watching your stocks or your portfolio at least every few months, it probably isn't going to take much more than an hour to check in on the ARK Invest website for those portfolio changes and then make the changes to your own portfolio. Again, probably less than an hour of work each quarter to save that $180 for every $100,000 invested. This is a simple strategy and a great way to follow these funds without paying those higher expense ratios. Click on the video to the right for the next generation of FANG stocks, 7 stocks that could produce the next Netflix or Amazon-like returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.